Hello.
Hey, so welcome to Adulting 101, our first time home buyer series, our session 2. Tonight, Joanne will be talking all about mortgages.
So do you want to introduce yourself?
Oh, well, I guess so. My name is Lori Sharpsteen. I am a realtor and owner of Out of the Box Properties, a team of agents that help people buy and sell homes.
And I'm Joanne Worobec. I'm a loan officer with Homestead Financial Mortgage. My goal here is to help give guidance and transparency throughout the home buying process. I want to help you succeed.
And honestly, Joanne and I started talking about this, I don't know, several months ago. I don't even know how long ago. But what we find in both of our businesses, and we have so many clients that are in the similar situation of really wanting to buy a home and really wanting to know how to do that, and they just don't know what's involved. So we sat down and decided that we were going to design this series to be able to help answer a lot of those questions.
And it seems like the questions are redundant. So each first-time home buyer has the same exact questions, and you don't know what you don't know. So that's the point of this, is that we're trying to help you, understand what you don't know.
Yeah, exactly. We both see so many parts of our society and our community saying, well, why don't people already know how to do this? Why don't they know what escrow is? Why don't they already know about mortgages? Well, if no one has ever explained it, how would anybody possibly know?
So and how would you know to go search for it either?
Yeah, exactly. So instead of listening to more people saying, well, somebody should teach them, Joanne and I decided we're going to be somebody.
And we brought on a network of people to help as well. So we have experts in a variety of different fields who will also be helping us with the seminar series.
Yeah, you'll be hearing from a different subject matter expert every single month. We will, however, reach out to all of you that we have information from to be able to offer to connect you one-on-one with any of those experts. So if you have questions about credit, obviously Joanne's the person to talk to about lending. But if you have questions about construction, or there's so many appraisals, so many different elements of the real estate process, and we have somebody who can answer pretty much everything.
Yeah. Okay, so we found a survey from 2018 where really it explains how first-time home buyers are very nervous with the process. So again, the questions that we receive are now demonstrated here from the survey. So less than half of the people feel prepared when home buying. Less than half feel prepared when home buying. The majority of first-time home buyers feel that they can't afford the home itself. They think that it's rigged against the buyer, and they're afraid of making mistakes.
And that part of it really kind of surprised me, but I guess it does make sense that 47% of potential first-time buyers they think that the home buying process is somehow rigged against the buyer. And if you're working with the right partners and are fully informed, then you have everything that you need to be able to get that done. But it can be very overwhelming if you don't know. Yeah. And there's a lot to sign. There's a lot riding on those decisions.
And 55% said that they could use an independent advocate as a coach. And again, that's kind of what we're trying to help here, is to put a network together so that our customers, anybody who has a question, they feel comfortable asking it and getting an answer and getting a trusted network for the process.
And Joanne and I have both worked for years to really hone and develop really good quality partnerships. So people
we trust.
Yes. Yeah, people who we trust with our clients, with our family members, in order to help them make the best decision, because it's very overwhelming. For example, I don't know how many loan officers there are in the St. Louis marketplace. I do know there are 14,000 licensed realtors in the St. Louis marketplace. There are, at this point, more realtors than there are available homes to sell. So how do you know who's telling you the right thing? How do you know who to pick or how to even go through the process. And I'm sure it's that way
Same
in
thing.
your industry too.
Yeah. Yeah. So, okay, so we're going to start dispelling some myths here. So, your first step is looking for a house.
And absolutely not. So it's almost intuitive to think, well, I want to buy a house. Where's the first place I need to go? I need to look at Zillow or Realtor.com. Maybe, press that little button and talk to somebody and have them show me a house. And that's absolutely the opposite.
No, you could talk to a realtor first, but really, what should you be doing?
You really need to have a quality conversation with a lender to determine how you're going to pay for that house, what your mortgage options are, and more importantly, how much house are you comfortable purchasing? Not just how much can you afford. So it's not like when you apply for a credit card, right? And they give you, oh wow, you have a $10,000 credit limit. Well,
you don't have to use all that money.
Right. That doesn't mean that it's a good decision for your budget to run that thing all the way up to $10,000, right? And that is probably one of the very few things that are similar in the credit world between getting a mortgage and getting a credit card. But most people assume that the whole rest of the process is the same, and it's not.
Right. So the first thing we need to do is we need to get our borrower pre-approved, our customer pre-approved. And you don't want to start the home shopping process because we need to make sure that you're in the right price range, for one, in the right monthly payment, for two, and three,
that you're ready to actually pull the trigger and move forward if you walk into the perfect home that you love. So, for example, we were talking about this earlier. The Out of the Box team had a listing, beautiful home, 4-bedroom, 4-bath in O'Fallon. It became active on the marketplace on Friday. Showings actually started Thursday night. We had an open house on Saturday. It went under contract on Monday. So, if you, for example, if that was a perfect house for you and you had not already gotten a pre-approval and you walked in over the weekend, you would not have been prepared, and you couldn't have been one of the multiple offers that we received for that home.
Right.
And the way that the marketplace is running right now, because there are so few homes compared to buyers, you have got to be ready to move and move fast in order to get that home that
have
you
your
really
A
want.
game.
Exactly.
To put
Your
the best
face
proposal.
forward.
Yeah, exactly. So that being said, like, how soon should you start that pre-approval process in your
In my professional opinion,
professional
you really need to start the process as soon as you start thinking, hey, I think I want to buy a house. And there are a lot of buyers who think, oh, I need to kind of look around first. I need to learn about it first. But there may be things that you need to address or that you want to address about your financial situation that will improve your experience.
Exactly.
And that you may need some time to get that done. It also gives you more time to really get a good handle on what all of your options are and what the best step is for you, so that you don't, let's face it, this is probably the biggest purchase of your life. Do you really want to feel rushed doing it, or do you want to feel confident that you really know exactly what this is going to look like at the end?
And you were saying in this market, is that a unique experience where you have the home going that fast and that many offers?
Yeah.
Not right now.
Not right now. And if you're interested enough in the home buying process to have clicked a link to tune in here or to get this information, you probably already know that good houses that you probably want to purchase, are moving incredibly fast. They're selling for oftentimes much higher than the list price. And there's lots of things that are wrapped up in making that offer, different contingencies. You really need to know what all of that means and what that means for you financially, and you're not going to be able to do that unless you've started that process early.
Correct. So let's talk a little bit about who you should go to get the financing. So there's a couple different people that you could go to. You could go directly to the bank, to a mortgage lender. They're somebody who will be able to underwrite the loan. They may have a little bit more swiftness because they have control of the whole process from start to finish. You may know them. They may have a relationship with you. You may already be banking at that institution, and they may give you a little leeway here or there, or offer a different kind of loan product, which is great. There's also then a mortgage broker. And a mortgage broker acts as an intermediary between you, the borrower, and the lender. So they're able to shop for all kinds of different loan products, shop for the best rates, everything like that. There may be some extra added fees because now you have a middleman. Neither one are bad, neither one are good. They have their advantages and disadvantages. What I would personally suggest, though, at the end of the day, you need to trust whoever you're using. And so, how long do you think that, on average, a borrower is going to be working with the realtor and the lender?
On average, particularly in this market, if you're a buyer, it may take, it could easily take a couple of months to find the right home, make enough offers, and get it accepted. So you are most likely going to be working very, very closely with that lender and that realtor for several months, if not longer. I know both of us also work extensively with our clients after they've made the purchase to make sure that everything is going as it's supposed to go. But because in this marketplace it's not as easy as walking in and saying, oh wow, I like this house, this is a list price, I'm going to write the offer for list price and they're going to accept it. It is not unusual for me to go through that process with a buyer 6, 8, sometimes 10 times before we get a contract accepted for purchase. So, and it's very stressful. I'm not going to pretend that it's really easy and it's all butterflies and roses, right? Because it's not. It is very stressful. So you have to be able to work with people who understand the stress and can help talk you through it and walk you through all of it.
And minimize the things that you don't need to be getting anxious over. Let us handle the minutia.
Yeah, exactly. And but you are going to be working very, very closely with those people. So you need to be able to, have them in your on speed dial in your cell phone and be able to feel comfortable enough to text them, email them, call them whenever anything comes up.
If they're not on your speed dial, you probably shouldn't have them, and you should probably get a new one.
Yeah, exactly.
So, and I want to just expand on that just a little bit. While, you may be working with them for, a couple months, sometimes on my end, I may be working with them a little longer because there may be some blips on their credit report in which I can help navigate how to increase the credit score, or maybe they need to save a little extra money, which they weren't quite aware that they needed to have some extra funds for down payments. I can help with that process. So my side of it may be a little longer than
before we've got boots on the ground, running in and out of houses. You may have already worked with someone for several months very closely in order to get them from whatever position they were at to the position that they want and they need to be. And I think that's a very important part of this, is to understand that it is all driven by the goals and the needs of that client. Neither one of us are interested in bringing people and just working them through the hamster wheel of what everyone else does. It has to be a very individualized process, and that's one of the other reasons why you have to be able to work with someone you're comfortable with, so that you're comfortable enough to say, this is what I really want. Or maybe I want something non-traditional. Right, or this doesn't fit, or this doesn't work, or maybe you want a tiny house out in the woods because you want goats. Maybe you want a loft in the city. And there are elements of all of those very different scenarios that are going to be different on the mortgage side as well as on my side.
Yeah.
So it's important to be able to feel comfortable enough to share all of that.
Yeah. Okay. So what's one of the first things that a lender should be asking you when you go to make your pre-approval? For one, they need to know your goals, but they need to know what kind of a payment will fit into your budget.
Exactly. how much of your monthly income, how
Can you
much are you
devote?
comfortable spending for the total housing allotment, right?
Oftentimes, my customers will say, well, my rent, what I'm affording,
Right.
for rent right now, which is great. One thing that I would urge my borrowers to know, though, is that a mortgage payment is not only the principal, it's not just principal and interest. You really need to factor a little bit more into it. So you are always going to be paying taxes. You're always going to be paying insurance. You may even be paying mortgage insurance if your debt to income, or sorry, your loan to value
Right.
is a little higher. You will also possibly be paying homeowner association dues as well if you're in a planned urban development or a condo. So there are other costs that you should be calculating into that
Exactly.
monthly mortgage payment.
And it's important to also realize that where you're buying impacts that a lot. So you could be looking at the same house, the same $200,000 price, but because of where they're at, one of them has $4,000 a year in taxes, and the other one has $2,000 a year in taxes, and that has a huge impact on what your monthly payment is going to look like.
And oftentimes, what I've even been noticing is we may make assumptions of taxes in a certain state, maybe a certain county, but even subdivisions may have different taxes than its neighbor.
Yes.
So you really need to consider all of this together.
So one of the things that I would really caution anyone who's in that very, very early exploration, and you're just thinking, well, what does the market look like? Maybe you've called and set an appointment to talk to a lender, and you kind of want to look at properties and see what that might look like for you. So most of us go then to the internet sites, right? To Zillow, Trulia, Realtor.com, because they have all these cool pictures and cool valuations, and then there's a little button or a little part of it that'll say, this is your mortgage payment for this house. What you need to understand is that that's a mortgage payment just for the purchase of the home, that your mortgage will also include taxes and insurance and sometimes other factors that are not included in that. So I don't know how many times clients come to me and say, oh, I love this house, and they say that I can buy this $300,000 house for $700 a month, and I have to say, well, let's do the math. That's not really accurate.
Exactly.
So start working with professionals and working with the money person, who can really
give
help
you
explain all
a better
that.
estimate of what will be going into the house.
Exactly.
Okay, so once you have discussed the monthly mortgage payment, now it's time to get down to the nitty-gritty and actually start getting that pre-approval. So a pre-approval is really a physical, like a financial physical, where your lender is probably going to get a little,
down and dirty into your financial world.
Your finances.
Let's just call it what it is. They're going to ask you a lot of questions. It is not like filling out a credit app. There's a lot more at stake and a lot more involved.
We're going to be lending you hundreds of thousands of dollars. We need to make sure that you are able to repay it and that you can handle that kind of a payment. So we're going to look at your credit history. So we're going to ask you for your social security number, your birthday. We're going to look at your credit score, your debt to income ratio, making sure that you have stable employment over a certain amount of time. We're going to look at your income, and we're going to make sure that it hasn't fluctuated for any reason. And if it has fluctuated, we need to know why. So please include that if that's,
absolutely.
If that has happened.
And be prepared. Many of us in the world right now, including myself, are self-employed. So there are extra steps, extra processes if you're self-employed in order to go in that qualification process for a mortgage. You absolutely can do it. You just have to be prepared to pull a lot more documentation and be asked a lot more questions in order to get to that end goal.
After we have that kind of information, we are going to be asking for documentation to support what you've told us, because we can't just go by word alone sometimes you don't understand, like, that bonus may not be able to be included in your income. We know that, but you may think that it can.
Right.
You know, we may be looking at your employment, and you know there is some kind of blip on there, but you have a very valid explanation. But we actually have to document what happened, and you know who you're employed by or anything like that. So we're going to be asking for a couple months of asset statements, bank statements. We want to make sure that you actually have the funds in your bank account for closing, because that is important. You don't want to get to the closing table and not have the money to pay for the home. That would be horrible. And it could be costly because you could have a lawsuit for something like that. So asset statements, bank statements, pay stubs, W-2s. If you're self-employed, we may actually be looking at your tax returns. We may
your
be
P&L statements, your profit and loss.
Exactly. If you're retired and this is your first time home, if you're buying a home for the first time, kudos, by the way. But we may be looking at your awards letters for Social Security or pension or disability. So know that you know there may be other documentation that will be needed up front, and also know that the documentation that is required up front will not be the end all be all.
We
will most likely ask for quite a few more documents throughout the process, and it doesn't help to complain about it because it won't get you the loan if you do. You know, like just supply whatever documents is needed, and just
I
know
think
that
that is
needed.
a common misperception or misunderstanding, and that's you know, honestly, that's partially on our industry and our fault because we work so hard to get you through that pre-approval process, and then in other parts of the credit world, then you're done, right? But for us in our world, the validation of the ability for the company to loan you the money has really just begun. So then they start asking a lot more questions. So for example, I have a recent client who he's done the same job he's a driver for a big package delivery company, right? So he's driven the same truck, gone to the same hubs, worked the same routes for years, but because of some of the nuances of that industry, he has had 5 or 6 different employers because they're actually subcontractors of that package delivery company. So to him, when he's filling things out, well, yeah, he's had one job. Then they start pulling records, and technically he's had 5 or 6. And he doesn't even necessarily remember all of those companies that he's worked for. So then having to work through going back through all the records and being able to find all that data to validate it took a lot longer and was very frustrating, certainly for him, because he just wasn't prepared. He had no idea that that would even come up.
Hopefully he started early, though.
He did start. He started early. He was very diligent. He got everything done, and he after we looked at lots of regular homes, of pre-built homes, made a couple of offers. We even went under contract with one, and then we ended up having to cancel that contract. And now he's having a home built, and we went with new construction.
Beautiful.
Perfect ending.
That's excellent. Okay, so we're going to go on to a little lender math here so that you understand some of the terms we're talking about. So the first one I wanted to discuss was debt to income. And so with debt to income, it is basically what it sounds like. So we're looking at your monthly debt payments as compared to your gross monthly income. Now there's 2 kinds of debt to incomes that lenders will discuss. The first one is front end DTI, and the other one is back end DTIs. The front end DTI takes all of your liabilities, so credit cards, car payments,
rent,
student loans,
right.
And they will then compare that to your monthly income. It's not including the monthly house payments, though. Anything that has to do with the house, they're just looking at your monthly liabilities. The back end debt to income takes into consideration the house. So we're going to be looking at your principal and interest, your taxes, insurance, your homeowners association, those kinds of things. So we're taking all of that into consideration as compared to your gross monthly income. There are 2 ratios then that lenders are generally using. Again, the front end of DTI and then the back end DTI. Generally, as on average, we're looking at a 28% front end and a 43% back end. That changes a little bit depending on the loan product, but that's a good rule of thumb, 28-43. Okay. The next lender math we're going to work on is loan to value. So the loan to value is the mortgage amount divided by the appraised property value. The higher it is, the more likely you're going to have mortgage insurance tacked on to your monthly payment, or a higher mortgage insurance tacked onto your payment. The lower it is, the less likely you are. So it just depends on the type of loan program you're with, but that's something to discuss.
So essentially, the bigger the gap between the appraisal and the amount of money you're borrowing, the better overall picture and scenario you have to be able to have lower payments.
Correct. Yeah. So if you think about it, the lender wants to reduce as much risk as possible. Like they don't want risk, and so if the loan to value is lower, that means they have less money in that house, and they have a higher likelihood, if you were to default, they would get their money back.
Yep, that makes perfect sense.
Okay. So now we're also going to discuss escrows, because we will be talking about escrows here in a second. So an escrow account is basically an impound account that holds money owed. And so within that monthly mortgage payment, you have principal, interest, and then you also have taxes and insurance. Now, you could pay taxes and insurance on your own. However, most lenders actually will give you a rate break by allowing them to collect it and put it into escrow. So they will collect your taxes and insurance, and then they will pay them when it's due. The reason why they'll give you a rate break on that is, again, it reduces risk. They know that the taxes are going to get paid when they need to get paid, and no liens are going to get assessed onto the property. They know that the insurance is going to get paid. So say your house goes up in flames, they know that their investment, their collateral is still protected.
And honestly, if you think about it, it's in many or most scenarios, it's in the borrower's best interest too, because
Absolutely.
if, so you forget to make an insurance payment, or the bill gets lost in the mail and you never see it and you don't realize it's due, and then a catastrophe happens to your house, you don't want to suddenly then realize you're not covered and you're not insured for that loss. So, so essentially what you're saying is that the escrow account is like a little place within that account that with every monthly payment, they're dropping some money into that bucket, and then at the end of the year, they're taking the money out of that bucket and actually paying the taxes and sending the payment to the insurance company, right?
Correct. Okay. Next, we have mortgage insurance. We've mentioned that a few times. So it's an insurance policy that the borrower has to pay, but it only protects the lender.
Right.
The goal in the long run is to not have to pay mortgage insurance, because it does not benefit the borrower, it only benefits the lender.
And that's that big PMI, that buzzword or buzz term that you see all over the place. And people say, you don't want to pay PMI.
Different loans will have different names for it. MIP, PMI, that kind of thing.
That's right, I've seen some.
However, it generally is the same. It's an insurance that gets paid to the lender to protect their interests. It removes the risk so that the borrower can qualify. Okay? So again, the overall goal, long-term goal, is to not pay mortgage insurance. That being said, most first-time home buyers may not have the down payment funds to get to that level. But doesn't matter, not really, because if the goal is to get in the house, you do what you do.
And it all depends on how the numbers and how the math works. In many scenarios, or most scenarios, you are in a better financial position going ahead and making that investment, paying the PMI for a period of time until you don't qualify for it, to have to pay it anymore, because the financial benefits of owning the home for that time period outweigh what you have to pay for that insurance,
Because
right?
during that time, your home is going to appreciate. You'll be getting more equity in your home while you're reducing the payment. So you're reducing the principal amount due. So you're creating a gap of wealth faster if you own the home than if you don't. And so when you get to that point that you can refinance and get yourself out of mortgage insurance, it's going to be sooner than it can be if you just save.
And these past several years of the marketplace is a perfect example of what that looks like. So homes have been increasing 6, 8, 10%, depending on where they're at and what the home looks like per year. So I know of clients who maybe they bought a home for, well, I know of one in particular, they bought a home for $183,000 3 years ago. Right now, it would appraise for $210,000. So that's equity that they built during that time that they wouldn't have built if they hadn't bought that house, right?
Exactly. Yeah. Okay, so let's go to the next myth. Your down payment must be 20%. So, no, this is a myth. But what does that mean? What does 20% mean? So 20% means loan to value.
Right.
So we're going to take a look at some of the different loan options and look now at what your down payment has to be, minimum down payments have to be, and some other attributes of the loans themselves. So the first one we're going to look at is an FHA loan. So this is a great first-time home buyer loan. It has a low minimum payment of a 3.5%.
As a down payment.
As a down payment, it's a
not 20, 3.5.
3.5%. Credit score is a little bit more flexible than some of the other loan offerings, and it's, they want you to be at a 580 or above. There is a range where you can be lower in your credit score. You will probably have to offset the risk by bringing more of a down payment, so 10% down payment.
But still not 20.
That's still not 20. And so some other key features of an FHA loan. So depending on how much you bring down, bring to closing, you may have to pay mortgage insurance over the life of the loan or for an extended time. So, that is something to consider. There is a funding fee as well that can get wrapped up into the loan. Your debt to income ratio really should be 43% or less. It is more forgiving. It's a more forgiving type loan, and so you may be able to go above that, but your lender will have to discuss that with you. The home must be the borrower's primary residence. You can't
use this for investment property.
Correct.
You got to live in the home that you're buying with an FHA.
Correct. It's a government-backed loan. It does allow family and employer gifts. And we should talk a little bit about that. So there are certain ways to finance that down payment. One is through your own savings. The other way is
through a gift. It is not at all uncommon in the marketplace for a parent, a grandparent, a friend to help contribute to that down payment. But they have to follow a very specific process to do it in order to get the loan to go through. And that's one of the elements when we were talking earlier and saying after you get the pre-approval and go under contract, there's a lot more stuff that has to be done. Yeah. So if for example, you're getting a gift of $10,000 from your grandma, first of all, go grandma. But there's a process in order to do that.
We still have to source it.
Yes.
We
so what that
have
means
verification of funds.
Is that when you're talking to grandma about that gift, please make sure she understands that your lender is still going to need some information about her bank account and to be able to
She's got to
trace
be willing
back
to provide that information.
Exactly. So I have been in several situations where we've gotten to that point and the gifter has been very reluctant or doesn't understand why that lender
be that
needs
invasive.
a copy of their bank statement. And that's just part of that process. Also, the timing of that gift is very important. So it has, and I don't even know how long, but the money has to season, meaning it has to move and then sit in your account for a certain period of time. So seasoning, not salt, not pepper, seasoning by hanging out there in the account so that it has some a length of time that it's been there. So you can't have grandma give you a loan the day before closing and just write you a check and expect that to work. It's a gift. That's a very critical part of it. So that because it can't be a loan, it has to be a true gift. So nothing where there's anything in writing or anything that you guys have agreed that, you know, oh grandma, if you give me that $10,000 now, I'll pay you back in 2 years. That's not going to qualify within the loan.
Right. And I did put on this slide for the FHA that employer gifts are allowed for this one. Again, there's some nuances to this one, so it's not an often used.
Right, but there are employers that I've been aware of in the past that do, as an employee benefit, offer first-time home buyer grants or some sort of a program. But make sure, first of all, check your employee benefits because it may be in there and you may not know it, and then make sure that your lender knows about it.
Right. Okay. Next loan type is a VA loan. So this is great for active or retired military. 0% down payment. I mean, you can't get much better than that. They have great rates. The lender minimums. So while the government, because it is a government-backed loan, they don't have minimum requirements for a VA loan. The lenders do for this particular one. And so you may find credit score minimums between the ranges of like 580 and 660.
But what an amazing benefit to be able to give our military, people who have chosen to serve and to sacrifice, and their families in order to help get them into home ownership. And one of the, I've worked with several clients with VA loans, and I love being able to do that business. There is also another myth in the marketplace around VA loans that they're very difficult for the seller, and that's not at all the case. There are a couple of different extra steps, but if you're working with people who are comfortable and fluent with them and have done them in the past, there is absolutely no reason that a seller should not accept a VA loan. Right. Just as any other one. But that is a misperception in the marketplace that utilizing a VA loan makes your offer less desirable, and that doesn't have to be the case.
Correct. Yeah. And as we were also talking earlier, we were talking about different documents. You know, VA members are going to have to provide some other documents.
Yeah, some documentation that they qualify for that particular loan. And most anyone who qualifies for a VA loan is probably already used to the government requiring information and documentation from them. So this is just another step in order to be able to do that.
So there's a one-time funding fee with this loan. However, if the service member has disability, that funding fee is removed. DTI, your debt-to-income ratio should be less than 41%. It's a little bit more stringent with this one. Government-backed, but it also is more forgiving on foreclosures and bankruptcies. And so you're able, even if you still have it reporting to your credit, you may still be able to get a VA loan.
Yeah. So the end message there is, if you have served, first of all, thank you for doing that. But if you have served, then talk to your lender about that as one of the different options for you to look at, so that you can determine which of those loans is best for you and your situation. Sometimes it'll be the VA, sometimes it may be using a different loan type. You don't know until you really go through the whole scenario.
Correct. So moving on to a USDA loan. So USDA loans are more for rural areas, rural or suburban areas. They do require you to look to see if the property is in the eligible area. There are some income limits as well. So, this loan type is really great for people who may not be making a lot of money, but have really good
Right. So by income
financial history
limits, what you mean is you cannot make over a certain limit,
Correct.
not that you have to make a certain amount, right?
Correct. You'll cap out at a certain
Right.
point. So you do need to actually look to see if you qualify.
If you make too much money for a USDA mortgage, it's possible. But then there are other loan options available. But this particular loan type, and we're working with several clients through the Out of the Box team who are utilizing USDA very specifically. So that's all we're looking at are properties that qualify for that because it's going to get someone who maybe doesn't make a ton of money and didn't think that they could buy a home. It's going to allow them to be able to do that.
Correct. Yeah. So again, 0% down payment. That's
Yeah.
can't get much better than that. And then credit score. Again, they're looking for people who maybe might have a little bit better of a financial history. So the credit score 640 or above, generally.
Yeah.
Above.
So people who may not have a higher income, but they have been very responsible with the income that they have, and they've handled their debts very well. This is a perfect scenario for someone in that position.
So there is a monthly guarantee fee included in the mortgage payment. This gets reassessed every year, and so that will go down each year. It's not a constant. Your debt to income ratio should be a little less than 41%. It is government backed. There are income limits, but you can go to the USDA website and input the information to see if the property qualifies and if you qualify. And then you may actually be able to roll the closing costs into this loan. So that's another
That's huge.
selling, benefit for this loan.
Because closing costs can be anywhere between 2 to 5% ish. Closing costs include the cost of the title company and lending fees and lots of other different things that Joanne will talk about in a few minutes. But if you can, this program could allow you to really go in and purchase a home without having to bring money to the table.
Correct. Now we're going on to the conventional loan, and this is really eventually where you probably want to be. But there's a couple different types of conventional. There is a product that really wants to compete with the FHA loan. This is for, again, people who may not have a huge income, but also has a pretty decent credit history. So they've reduced the minimum down payment down to 3%. They're looking for a credit score right now above a 620. Again, there may be some income limitations here, but it's a great first-time home buyer loan. The standard conventional loan has a minimum down payment of 5%. Again, much less than the 20%.
Not 20, yeah. So, and that's such a huge myth that, if I get a conventional loan, I have to have 20% down. No, you can use a conventional loan and qualify and only put 5% down.
Exactly, yeah. So the credit score, we really went above a 620 at this time, but the best pricing is really given to those above a 680, even above a 740. Those are the prime. So the higher you can get your credit score, the better off long term you'll even be as well.
So again, if you're thinking, hey, I want to own my own home in a year, the time to start is right now, because if you're in this scenario and your credit score is close, but you could do a little bit of work over the course of the next year and bump it up to those prime levels.
A month. I've seen people raise their score pretty drastically within a month with a little guidance.
Yeah, that's amazing. And it can make such a big impact on your financial picture for the future by taking that time and doing the work right now.
Okay, so the great thing about this loan is that mortgage insurance is cancelable when the loan hits a certain LTV, loan to value. So generally, mortgage insurance drops off if it's at an 80% loan to value when you're getting the loan. when you're already into the loan, it will automatically go off at 78%, unless you can show an appraisal or something like that, that your home is already at an 80% loan to value, and then you can ask the lender to have it removed.
Gotcha.
So there's also, besides the loan types that we've talked about, there's also other programs that may be available on the local, state, federal level. We're not really going to talk about those here right now.
Yeah, that's a whole nother seminar.
Yes, but know that you can do some research though, and you can actually start the process to get some grants, look at forgivable seconds, that kind of thing. Those kinds of down payment assistance and just assistance in general can be beneficial, and you should do your own research on this.
Yeah, some of them, they may require that you go take a class, do some training, get some education. They may have different kinds of qualifiers. Some of them have different levels of assistance available depending on the geography of where you're purchasing. But getting started early and doing some research on them is absolutely to your benefit. And I've had several clients who have utilized some of these programs and literally were able to go in. They didn't have to, not only did they not have to bring money to closing, they bought a house, we went to closing, and the title company gave them a check.
Amazing.
So it's just, so it does happen, it is possible. It requires some work, it requires some steps.
It may be a little harder, and it may take a little longer.
Yeah.
Just know that, but at the same time, there are programs.
But it happens.
Okay, so the next myth: the down payment is the same as the closing cost. So we've already kind of touched on this, but no, the down payment is the minimum requirement for the loan, but there will most likely also be closing costs that get assessed. So you have a bucket, right? And when you get to the closing table, you're going to bring a cashier's check, or you're going to wire the money.
Yeah, don't bring cash. No Benjamins, no.
No personal checks.
No personal checks either. And trust me, your trusted advisors will walk you through every step of that process as you get closer, so that you don't forget. You don't have to remember all of this now. But you do have to bring a cashier's check.
Or a money order.
Or a money order.
You'll be wiring the funds or whatnot.
You have your bank wire.
You will have a bucket of money, so to speak, that you will have to give to the title company. The title company holds it for you and then will disperse it to the relevant parties. That bucket is actually comprised of your down payment, which you've already probably given earnest money, so that gets subtracted. But then you also have other costs, such as the appraisal costs, any kind of inspection costs, attorney fees possibly, title fees, survey, insurance, taxes, prepaid interest, all that kind of thing. So
yeah, this is the bucket where they prorate between the seller and the buyer, right? If the taxes for the year, because you typically are not making this purchase on the very last day of the year when taxes are due. So if you buy it in July, well, the seller owes for taxes up until during their ownership, and then the buyer owes for then. And you only pay the bill once at the end of the year, so you have to. The title company figures out all the math and prorates it and makes sure that everything goes where it's supposed to go. So you'll see sometimes 2 or 3 pages with just lists of, because they have to tell you everything that they charge you, every fee for a wire, every fee for filling out a form. So the title company, they're a business, and they have charges in order to do their process. Buying the title insurance, if you're a buyer, is a big chunk of that. So there are a lot of different elements in it. So be prepared to have to come to the closing table, typically, unless you're using one of those programs, with your down payment and additional money for the closing. So what we find is that a lot of buyers, a lot of first-time buyers, they just don't know what they don't know. So they think, oh, well, I need 10% down. So I have my 10% down. Right? Here it is. I'm ready to go. And then we have to say, well, but you need another 2 to 5% to be able to cover these. And it's it can be very disheartening, right?
And we've talked about gifts as a possible way to get down payment funds.
Mm-hmm.
We've, there's also seller concessions.
Yes.
So there are ways that your realtor can help, like, negate some of the funds that are needed to come to closing. However, that being said, in this market, it's pretty tough right now to get seller concessions. So you really should have the money saved to be better prepared. And whatever money you put down on, on your home, that benefits all the other things. It benefits your debt to income. It benefits your loan to value. You may be paying less mortgage insurance. So the more money you have saved is better, right?
Yeah, absolutely. And this is another point or another part where it really is critical to be working with the right people and working with people that you trust, because while in the current marketplace is essentially that there are this many houses and there are this many buyers. So there's a big gap in between. So that puts a lot of stress on the marketplace. However, deals do still happen with seller paid closing costs. It just has to be written and designed correctly, and you have to have the right agent who can identify the right property that you can even do that on.
And the goals.
And the goals
of the seller.
The goals of the seller, the goals of the buyer. So we have it out of the box. We have one closing in 2 weeks. That is exactly that scenario. We were able to get seller paid closing costs and some other concessions to be able to cover all of the closing costs.
Which is amazing.
Yeah.
That doesn't happen all that often.
It doesn't. It doesn't. But everything's got to be just right.
Exactly.
But don't sit on your hands and say, no, I don't even want to start this process because I've read on the internet, or my great uncle Henry said it's absolutely impossible right now to be able to get seller paid closing costs. It's not impossible. You just have to be prepared that it's going to be some work.
Prepare for the worst, hope
Exactly.
for the best.
Exactly. And it does get done.
Yes. So the next myth, you can't afford a house, which we know that's not true. So of course you can. If you pay monthly rent, you can most likely have a mortgage payment. That being said, maybe your financial history is not absolutely perfect.
And let's be honest, okay? Nobody's financial history is absolutely perfect. There are very few. I'm sure you probably have run into one or two people who have like that perfect credit score. I have not. Okay, I can honestly say I have not. Everybody has stuff. So so your stuff is unique to you, but everybody else has it too. So it's not unusual for either one of us to be working with clients who are working past a bankruptcy or have other financial, maybe there's a medical bill that you didn't even know existed and it suddenly popped up on your credit. Those things happen. And they just happen.
They happen.
But with good planning and a good process put in place, you can move past all of that and buy that home.
Exactly. But again, like the slide says, when in doubt, call. So if you are even, that there might be a blip somewhere in the history, that doesn't necessarily mean that you won't qualify or that you won't qualify in the future.
Right.
So if you are questioning it and you are looking to be a first-time home buyer, please call your professional to have them review your situation with you, because they know more about what will get you qualified than you do. And if there is something that can be worked on, they can identify it, help you get to where you need to be, and have you in a much better scenario and better prepared for buying that home.
Right.
So always call your professional and just
with
ask.
any question. Yeah,
Exactly.
that's why you have them on speed dial. Call, ask, send an email. I get text messages, Facebook Messenger. I have clients that I've worked with almost exclusively through Messenger, just because that's how they're comfortable communicating.
Exactly.
So go ahead and send those questions when you're thinking about them. That helps give us a better picture in order to know how we can best help you. So trust me, just like when you go to the doctor, there's nothing that you're going to tell us that we've not seen or heard before. There's no judgment.
And we would rather not have surprises. Just tell us.
because we can better help you having that full picture.
Exactly. So that being said, we have a number of different online tools and resources. We've already talked about the fact that we have our network and our partners and our experts, but we also have our Facebook page. We have a YouTube channel. We are going to be sending out the home buying guide. We are available if you have any questions, call, text, email, messenger.
Yeah. Snapchat gets a little snaky, but that's okay. If that's what you need, that's cool. But we are here to be able to put in your hands all of the tools you need. So please join us on the Adulting 101 Facebook page. It's a great place to get more information, a great place to ask questions. Your questions tell us what you need and who we need to bring in for these seminars, right? So if you have not shared with us an email address, please go ahead and send that to us, or just let us know on the Facebook page. We have an extensive first-time homebuyer guide that we're happy to send out to you for free that will walk you through that whole process. And we have tons of additional resources. So if you have signed up for this through Eventbrite or wherever else we ask for people to sign up, we will be sending you an email just with a chart that will say, these are different topics. Who would you like to hear from about credit or about insurance or about
to answer questions too.
Yes.
Like, just email us a question. It's fine.
Yeah.
We'll get it to the right person if we can't answer it.
Exactly. And absolutely reach out and schedule, if you want to schedule a 15-minute phone conversation, a half-hour Zoom, a coffee, whatever, to be able to walk through this process, please don't hesitate. So we're not going to charge you money for our time and attention, right? That's not how this works. We get paid when someone actually meets their goal and gets to the closing table, and we want to help you get there in the best way that you find possible. So so don't be shy about scheduling time. Right.
So some of the future experts that are going to be on our seminar series, we've got on April 27th, Tuesday, April 27th, we've got Scott Shipman, who is the St. Charles County tax assessor. He's going to be talking about basically how taxes can affect your monthly mortgage payment, which a lot of first-time homebuyers don't know about. And so we're trying to, again, make you better prepared and see how you can mitigate, some of those tax assessments as well. So we've got a number of people, if you're looking for new home construction.
Oh, Dawn's a great person to talk to about new home construction.
Exactly.
If you're trying to figure out finances and budgeting, talking to Meredith, right? She can help you with that whole process and has so much information to be able to help you wrap your head around which buckets to put your money in and how to move things around. How do you take care of a house? So that is, according to research, that is the number one thing that first-time home buyers are surprised about after they buy a home. They buy it, they move in, and they're like, oh my God, how do I take care of this thing?
And one thing we haven't quite touched on is that while you have a monthly mortgage payment, you really want to have some money set aside too, because
things are going to happen.
Things are going to happen. However, we do have home warranties as well, so we'll be speaking.
Yeah, there are people here within this network, and so some of our future seminars are about home warranties. What do they look like? What do they cover? A home warranty is not the same as homeowners insurance. Two completely different things, right? Helpful tips on taxes. So how does purchasing a home impact your taxes in your tax world?
How can you
So Michelle Walsh does a great job of explaining that. Yeah, how do you, she can help you do the right things to help reduce your tax responsibility implications.
And then, again, we've got a few other ones. So rehab construction, how do you repair your credit? Again, we talked about the home warranties
with Marsha and Heidi. Julie, who works with Out of the Box, is a great life coach. So if you're just trying to figure out how to put all this stuff together, she's a great person to talk to about that. Nikki Shear is an expert on our team in non-traditional housing. So if you have an interest in container homes, tiny homes, schoolies, wheelies, any of the E's.
I don't even know what those are.
Really? Oh, schoolies are so cool. You take a school bus and you make it into a home.
Ah, gotcha.
And
I just didn't know the name.
Yeah. A wheelie is building a home on top of a trailer. So it's a home on wheels, but it's not designed like a travel trailer to move a lot, but you have the ability to be able to move it every 6 months or and there's lots of interest in that marketplace. So Nikki, you'll be talking at one of our seminars as well. If you have interest in any of the things that we just talked about, though, please reach out and we will connect you one-on-one with these experts so that you can get all of your questions answered and they can help you with that process.
Okay, so again, we've talked about what's coming up next. April 27th, we have Scott Shipman with the St. Charles County Tax Assessors.
Hopefully I'm not the only one. I'm really excited about that.
I want to know more about how many taxes will change. So.
I mean, it sounds, I guess, I must be old if I'm saying, the tax assessor, that's really a sexy topic, to be able to talk about taxes and what gets figured into it. But that's also a question that I've seen a lot. I've had from first-time home buyers, and then I've seen a lot on Facebook.
Home buyers, regular, people who already own homes.
Why are my taxes so much higher than your taxes?
Exactly.
And what can I do about it?
You don't really notice how much it impacts your finances until the new assessments come out. So
right.
I'm pretty
when
excited about that one.
When we're to the point of looking at homes, taxes is something we're going to talk about with every single house we look at, because if one is $2,400 divided by 12, that's $200 in monthly payment. If another house that you like just as much only has $1,200 in taxes, that's only $100 a month. So that all has to be taken into consideration when you're deciding which home you want to buy.
And then after that, we have Money Matters with Meredith, and then Home Warranties with Heidi. So we want to thank Jason Hardy and the rest of the Homestead team, Greg Aftiev, Andros Iacomidis, the other owners of Homestead. But without Homestead's help, and the marketing team, we wouldn't be here, and we wouldn't be
here talking to you right now. So for me personally, being able to work with a company, with this company, with Joanne, with Dave, with everybody on the team, to be able to help put all of this together has been just amazing. And this company is really invested. They've invested financially, they've invested in time, in labor, and they're just emotionally invested in making sure that the population of potential first-time buyers knows what they need to know and has all the information that they need in order to feel more comfortable with this process.
We want a more informed consumer. We want you to feel prepared.
So whether you choose to choose us or not, or someone else, you can work with me, or you can work with 13,999 other agents, right? I just want you to have everything you need to make the best decisions.
Exactly. Okay, so that ends our presentation. We've gone a little over time.
We did start a little late.
But
so we're going to try to give ourselves that grace.
One or two questions that.
Yep, we've got some questions here. One of them is, what is the difference between a pre-qualification and a pre-approval?
Okay, so the question is, what's the difference between a pre-qualification and a pre-approval? So a pre-qualification is basically taking some known items, some known facts that the borrower has given the lender, and using that alone to make a determination.
Right. So essentially me saying, hey, Joanne, I make $100,000 a year.
Exactly.
I have worked at my job for 10 years. And last time I looked, my credit score is 720.
Correct. There's no credit pull. We're just going on kind of a verbal affirmation of what's going on in the life. We're not really taking in the actual debts because we don't know exactly what they are. Because you don't know, because
I didn't tell you what I owed, did I?
There's a lot of stuff that we don't know. And so the pre-qualification just is not as strong as a pre-approval letter. So when you're going to make an offer on a home, you really want to have a pre-approval with the letter stating what you're pre-approved for. Because like we talked about earlier, we have just done a physical on your finances. We know what your credit score looks like. We know your credit history. We we have some basis in your employment and the stability and everything like that. So we have done a more thorough analysis so we can basically
they can better vet you. So,
Exactly.
and what that really means in the marketplace, particularly a marketplace like this one, is that if I as an agent, I'm working with a seller and I'm presenting them 2 offers, and they may be very similar offers, but one has been pre-qualified and the other one has been pre-approved, the client, the buyer who has been pre-approved has a much higher likelihood of actually making it through to closing.
correct.
That's really the biggest thing that the sellers are looking for. If I accept these offers, who is most likely to actually be able to get all the way to the closing table and do this deal, because this is a big risk. So they're going to go with the pre-approved one most of the time. I mean, I can never say always, but most of the time they're going to go with the strength of the pre-approval versus a pre-qualification. So what you may see sometimes is that it's really easy online. You know, you press a button and you go through to an online lender or an online site and you enter in your own data and they, boom, kick out and say, you are pre-qualified. That pre-qualification is kind of like those
Doesn't
credit
mean-
card offers you get in the
Yeah,
mail, right?
Doesn't mean a lot at this
No,
point.
it doesn't. What it really means is if all of this information is accurate and everything else in your financial world meets at least the minimum standards, then you would most likely be able to get a loan.
Yes.
But there's lots more information.
lot
So please, before we write an offer, please at least have that conversation and get to the point of a full pre-approval. It's just going to make your offer much more likely to be accepted.
And the goal is to get a house.
Yeah.
Okay, and we have another question that asks, how quick can I get pre-approved?
Okay, so that's a great question. It really depends on you. So we may get your information, we may be running all the information, but until we have the documents that we've asked for, we can't give you that pre-approval letter. So as soon as you can get us the documents that are requested.
So what documents typically do they need in order to get that pre-approval?
So we need 2 months of bank statements, asset statements, 2 months. We need to show that it's seasoned. You mentioned that earlier, that the money is seasoned, that it's not, that there's no weird.
It didn't just suddenly pop up out of nowhere.
Exactly. That we can't track.
No
you know?
mattress money involved in a mortgage purpose.
Correct. We're going to look at your W-2s. We'll need to see your ID. And
Oh, you want to know I really am who I am?
kind
Okay.
of, yeah. And your pay stubs. So we want to see how much you've made. We want to see if any of that is bonus. If you have a loan out on your income already, because some people have loans out on their income, and that we can't take that
Right.
take that kind of income then if there's a loan out on it. So there's a number of different things we're looking for. We're also looking for the consistency of it to calculate what kind of income we can actually
So
qualify
essentially, if I'm thinking I may want to go through this process in the next month, or I should really take some time and find those documents, find 2 months worth of bank statements, a couple of some of my pay
with. Full month
stubs.
of pay stubs.
Okay. And any large debts, anything that I have debt to income, if I've got student
provide
loans or
debts, we need to provide where
my money's
funds,
coming from.
Yeah, so
Okay.
we need to look at how much money you have in the bank. Say if you were to default on the loan, would you be able to still carry that payment for a number of months? So we're looking more for
Gotcha.
assets.
So if I have that stuff together and can give it to you, then how long does that process take?
If I'm right on it and I don't have anything else to do, I could probably whip it out in, maybe a half an hour.
Wow.
Maybe an hour. That being said,
Right.
lenders are busy and people have lives. And so if you're calling on a Friday at 5:00
Right.
for a Friday night or Saturday morning showing, just be aware that, people have lives.
And you've probably waited too late to really be able to get a good what you really need.
And if I need more document, like maybe you've supplied some documents, but the documents weren't quite right, they weren't formatted correctly. We need to see, by the way, the entire document and all pages, not cutoffs or anything like that. Because
not me just snapping a picture and then
yeah, and we'd prefer like PDFs as opposed to, JPEGs.
JPEGs.
But if everything aligns right, I can whip it out. However, that's not always, life happens and it might not be the right kind of format. So, just know that it can be the next day, but if there is an urgency, always let your lender know, because, we understand that this is a hot market.
Yeah.
We want you to succeed. So if there is an urgency, definitely let us know, and we will try and get that pre-approval letter out as soon as we get those documents.
And that being said, the time to call your lender is not when we're standing in the home and you've now decided this is the one I want to buy, right? So if I go back to that example of my seller's listing from the weekend that nobody was able to even look at it till Thursday night, it really didn't go active till Friday. So at that point, if you're waiting till after you've scheduled the showing for Saturday or Sunday to say, I might want to check and see how I can pay for the house, you've probably waited too late to be able to be in that grouping of offers that we were considering.
Really, you shouldn't even be looking at a home without knowing what your financial
exactly.
situation is.
I was hoping you'd say that. Yeah.
So, it is too late at that point. And also, you don't want to get to that, pre-approval stage. If you're already wanting to put an offer on the house, you don't want to get to that pre-approval stage and then find out that, maybe you have something fraudulent reported to your credit report that has knocked you completely down, and you're out of the game until that can even get fixed.
Right.
So it's better to know what your credit looks like as early as possible. And right now, especially with COVID, they're allowing you to get a free pull from each bureau once a week.
Once a week, wow.
So, now you don't have an excuse not to know what's on your credit report and not getting something fixed.
Yeah, because you do have access to it.
Access.
And I know we've said a lot in this presentation tonight. Get your pre-approval, get your financial world in order before you start looking at homes. Let me put one kind of qualifier on that, and that would be before we actually are doing showings and before we're ready to write an offer. However, what I do recommend is reach out to your agent, whoever that might be, and start doing some research about the market at large. Let them set you up with a home search so that you can get emails sent to you of what listings look like that fit your parameters, where you want to live within your price point, numbers of bedrooms and bathrooms. So you can start educating yourself on what is selling in the marketplace, how much it is selling for, and how quickly or slowly it is selling, so that while you're doing your diligence to get your financial world in order, you're also educating yourself on available homes and what that marketplace looks like.
Right.
Because then you're going to feel so much more comfortable when we start actually looking, and you'll be like, oh yeah, Lori, I know this because I've seen 4 other homes in this subdivision and they all sold for 4% over list price. So I know that I should probably expect
I should prepare for this amount
for
of money.
for this house to probably also sell for about 4% over list price, because that's what the market's been flowing at. So go ahead. Don't feel like you can't call. Oh, I can't call Lori until I've gotten everything done with Joanne. Go ahead and call me, and let's start that process so that you can learn more about that marketplace.
Correct.
So I'm sorry, we got way off track of that question.
We probably should.
Wow. Okay.
So if there's any other questions, and there probably will be, please reach out to us, and we will get back to you to answer those questions. Obviously, we ran over today because we like to talk, if you can't tell.
And we love what we do. So
please reach out to us. We'll answer whatever questions you have, and we'll get you with the experts you need if we can't.
And thank you for joining us and for putting up with our technology and starting late, and we're just figuring out this whole video Facebook Live thing. So thank you for your patience with that, because we were both kind of nervous about this. And and we absolutely want to hear what value you got from this, or what else you need to know, or any of your feedback. So we'll be sending you, you know, as we mentioned earlier, we'll send you some information, some requests to just click some boxes of, yes, I like this. I'd like to learn more about, I don't know, pools, whatever it is. And we'll find somebody.
Okay. Thank you very much. Have a good night.